Hello, and welcome to this month's 3 slides in 3 minutes. 10 downside risks to the U.S. economic outlook. There are a lot of things right now putting pressure on the U.S. economy. For starters, the recent downgrade from Moody's means it's more expensive for people and businesses to borrow money. At the same time, the trade war is still causing problems. Tariffs are making things more expensive, and there's a risk of countries fighting back with more tariffs. That's leading to less business confidence and making it harder for companies to plan. On top of that, shoppers are starting to spend less because prices are rising in places like Walmart. Student loan payments are starting again, tourism is down, and higher mortgage rates are slowing down home buying. All of this is adding up to lower consumer confidence and, in some cases, job cuts, like in some government positions. These 10 risks show why people are worried about where the economy is headed next. Liberation Day. This chart shows how cyclical stocks, which rise and fall with the economy, compare to defensive stocks, which are safer in tough times. Over the past year, markets have been falling because of things like trade wars, confusing policies, and slowing growth. But a key moment called Liberation Day happened when investors seemed to feel like the worst was finally over. Stocks had already dropped a lot, and that day felt more like a turning point than another crash. Investors started thinking the economy might stabilize, even though there could still be ups and downs. The news on tariffs was worse than most people expected, but it also signaled that the bad policy shocks might be behind us. Now the market is back in the same trading zone it was before Liberation Day, which might mean we've hit bottom or at least close to one. Volatility has risen and fallen with trade policy uncertainty. This chart shows that when trade policy becomes more uncertain, market volatility, measured by something called the VIX, also goes up. You can see how the blue line, VIX, and the gold bars, policy uncertainty, move almost in sync. Lately, trade policy uncertainty has dropped a lot, which is why the VIX is also lower. But this doesn't mean things will stay calm. Right now, both are probably as low as they can go, so it wouldn't be surprising if we see more ups and downs in the market soon. Even if prices don't fall much and buyers come in quickly during dips, that doesn't mean it'll be smooth sailing. Things like trade talks and other policies are still in progress, so more market swings are likely between now and the end of the cycle. Equities have shown rate sensitivity with 10-year yields above 4.5% threshold. Lately, people are less worried about a recession, but there's still a big risk for the stock market, and it's all about interest rates. Right now, the 10-year Treasury yield is sitting around 4.5%, which has been a key level for the past couple of years. If that yield goes much higher, history shows it usually causes stock prices to fall. You can see in the chart how stocks, the yellow line, often drop when the yield, blue line, rises past 4.5%. That's because when bond yields go up, it puts pressure on how much investors are willing to pay for stocks. Also, a recent credit rating downgrade for the US could add even more pressure. But here's the good news. If stocks fall because of this, it might only be around 5%, and some investors see that as a chance to buy. So while things feel tense, it's not all bad news, just something to watch closely. The US cannot replace most Chinese imports in a short time frame. Back in the 1980s, the US was the world's biggest supplier, with twice the share that Japan had. But now, the roles have flipped. Today, China is the main source of many important products the US imports, like electronics, machines, clothes, and raw materials. This chart shows how much the US relies on China, not just directly, but also through trade with countries like Mexico and others in Southeast Asia. If the US added big tariffs, like 100%, on all these imports, it could seriously hurt both economies. And it's not just about phones and gadgets anymore. These products are key to making things like healthcare tools, AI tech, and machines that we use every day. In the short term, cutting back on tensions could help calm the markets, but in the long run, it's clear that the US and China are closely connected, and pulling apart won't be cheap or easy. Thank you for listening, and if you have any questions, please let me know.